as Jim said, I was an '89 St. Bonaventure graduate, and I was actually a marketing major, planning to work in advertising. And when I graduated, the job offers I was getting, the pay was just so low that I really couldn't afford to, live in the city, or, it barely even covered my commutation
So
in the city.
where were you from, Kevin?
I was from Westchester County, just north of New York City. So, working in advertising seemed like a great plan to me. Seemed like there'd be a lot of opportunity, but it just, the money when you start out in advertising is just pretty low, and that was not something I was expecting. So, ended up getting a job with a local bank, but realized that, to move up the ranks, you really needed to have more concrete finance and accounting skills, which I didn't really have. I think I had taken some intro classes, but quickly went back to business school, got an MBA, and then ended up going into, back into banking, worked for Chase Manhattan Bank, and worked for, I guess, 7 or 8 banks now. Chase, I worked for Bank of Montreal, I've worked for Bear Stearns for almost 8 years, Barclays, CIT, and now I'm working at MUFG, which is Mitsubishi UFJ Financial Group. They're the 5th largest bank in the world. So during that time, my whole career has sort of been focused on leveraged finance. Basically, we're providing loans and underwriting bonds mainly for private equity clients who are looking to buy companies. And we will basically assess the credit quality of those companies, and based on our analysis, we'll decide whether to underwrite, loans and bonds to support the acquisitions of those companies. So back in 2015, after I had seen the movie The Big Short, I ended up writing this fairly lengthy rant on Facebook, and Jim saw the rant and said, "Hey, you got to come speak to my class. It'll be great." And so I ended up doing a bunch of research, and I had some pretty extensive notes. So when he asked me to come back and during this crisis to talk to you guys, I had some pretty good material, I think. To
you want to share your
upon.
screen? Do you want to share screen, or do you want to share screen, or?
I guess so. I mean, I'm gonna read what I'm gonna say,
Okay.
but
well, I will
sure.
give you guest host as well. So if you want to,
How do I do that?
So what you will do, so you're co-host now, and on the bottom, so you go down, and there's a little thing that'll say share screen.
Oh, yeah. Okay.
Click on that, and then you're good to go. There you go. You started screen sharing. Yeah.
So, so I'm gonna read a lot of this because it's not as fresh in my memory, but this was sort of an expanded version of what I spoke about, I guess, back in 2015 or 2016 to your SIM group. And obviously circumstances are different. We're in sort of a different financial crisis and different reasons why, which we can talk about at the end and talk about the government response. But I think that the government response is really the critical part that we should focus on, afterward. So let's see. Yeah. So as folks probably know, the Big Short is a drama based upon a book that Michael Lewis wrote about the mortgage debacle of 2007, 2008. I was working at Bear Stearns at the time, which was one of the biggest underwriters of mortgage-backed securities. I was well familiar with the excesses and greed of the mortgage business during that era, but the movie definitely brought me back to those very dark days for the country. And literally, I was having flashbacks as I watched the movie. So, sorry, I just lost my train of thought here for a second. Okay, so during that 18-month period of time, that was really the eye of the financial crisis storm, I lost 2 jobs. My dad died of cancer. I lost a significant portion of my net worth, and probably would have lost my home had it not been for a big inheritances I had received from my dad's estate. And all of these were sort of occurring as liquidity in the market was and my own personal liquidity was like evaporating before my eyes. Chase Manhattan Bank suddenly canceled my undrawn portion of my home equity line of credit, and cash was dwindling rapidly. And then with a family of four to depend on me to pay the bills and groceries, the fact that I was feeling a little stressed was sort of an understatement. So it didn't really last that long, but for folks who were in the middle of it and wondering, how they were going to pay their mortgage and pay for groceries, it was definitely very scary. So everything sort of started back in the spring of 2006. I was actually down in Naples, Florida, visiting my family, and I was at a barbershop getting a haircut. And I happened to overhear this one barber boasting about his real estate investing prowess. Now, it seemed pretty odd to me that a barber would have enough money to buy, multiple homes, but over the next 20 minutes, he was bragging to fellow customers about how he was able to purchase all these homes so he could flip them. Basically, all using mortgage loans, didn't require putting any money down. And he also didn't need to verify his dated income. And this was all sort of the mortgage fraud that was going on down in Florida during those days. As a trained corporate lender, I knew that being able to verify a borrower's ability to repay a loan by looking at their historical and projected cash flow and also having some sort of equity cushion in the underlying collateral were two very important pillars in any fundamental credit analysis. But back in 2006, that didn't seem to matter to anyone. And why was that? So basically, what was happening at that point in time is all the investment banks were underwriting these mortgage-backed securities. And I think it got to the point where they didn't really care so much anymore about whether the borrowers could repay the loans, as long as the rating agencies were willing to rate the tranches of these mortgage-backed securities as investment grade. And using those ratings, they were able to sell these mortgage-backed securities to investors by basically pooling them with other subprime mortgages. This sort of continued, I guess, for a few years until the spring of 2007, when the cracks in the facade of normalcy in the mortgage market began to appear. This was sort of a landslide that became an avalanche in February of 2007 when Freddie Mac, one of the largest government GSEs who are purchasers of mortgage-backed securities, said that it would no longer buy the most risky subprime mortgages and mortgage-related securities. Then 2 months later, New Century Financial filed for Chapter 11 bankruptcy protection. They were a leading subprime mortgage originator and lender, and by then the crisis was in full swing. It had become obvious to every market participant that the housing market was collapsing as over-leveraged borrowers were defaulting on their mortgages in record numbers, driven by the underwriting standards and the teaser rates that they were getting on adjustable rate securities, adjustable rate mortgages during this time. This made it affordable at first, but not during the inevitable rate resets. One example of this sort of loan offered during those boom years was called the Ninja loan, which was essentially a very low quality subprime loan with Ninja standing for no income, no job, and no assets, because the only thing the applicant had to show was a high credit rating, which was presumed to reflect the willingness and ability to pay. With these higher default rates, a significant number of homeowners and real estate investors all rushed to sell their homes at the same time, hoping to avoid a default. This flooded the market with inventory, which triggered a significant decline in market prices. And then with that decline, the value of these mortgage-backed securities fell off a cliff when it became clear that a significant number of homes were underwater, meaning that the value of the home was less than the value of the mortgage balance. So I don't know if you guys have ever seen the movie margin call. This was the same story at Bear Stearns. We had effectively lent billions and billions of dollars effectively to buy homes in Florida and elsewhere at inflated prices. And then our balance sheet had ballooned with all these mortgage-backed securities. And the problem with that is there's a time lag between making the loan, packaging it up, and then selling it to investors. And during that lag, basically the mortgage market fell apart, and we had to write down billions of dollars of our mortgage-backed securities holdings during that period. So that was really the cause of the start of the financial crisis. I was working in leveraged finance at Bear Stearns during that time, where we financed leveraged buyouts of companies backed by a variety of private equity sponsors like Blackstone, KKR, Bain, and typically in every leveraged finance transaction, you have a private equity client who would line up financing. Typically, we would provide 75% of the purchase price, and then the private equity sponsor would use their fund's equity for the balance of the purchase price. Typically, this financing would be agreed upon several months before the M&A transaction was ready to close, and the rates and spreads on the debt would be decided months before the debt financing was ready to be marketed to debt investors. This timing mismatch created sort of a conundrum, since we and the other underwriters would be taking market risk, basically the risk that the rates or credit spreads on the rates would increase between the time the commitment had been agreed upon and then the time the debt was sold. While some underwriters attempted to address this market risk by including so-called market flex language in our debt commitments, this flex was typically capped. So there was some degree of risk involved in syndicating these debt commitments, since we'd potentially be on the hook for these huge unsold or hung debt commitments if spreads move more than the market flex. During the spring of 2007, the leveraged finance market was really on fire, with PE firms buying up private and public companies alike, and our firm was definitely in the mix with a pretty massive pipeline of forward commitments. As spring turned into summer, it was clear that troubles in the mortgage market were beginning to spill over into the leveraged finance market. Loans that might have cleared in the market at LIBOR plus 350 in March were now required much higher spreads, with our market flex capped at some cases at 150 basis points. So we basically needed to start selling these loans into the market at a loss. Sorry, just lost my train of thought here for a second. So by the fall of that year, the same loans that might have been, at par were now selling at 85 cents on the dollar. So then, just going back to the Bear Stearns example, as trouble brewed in our area of the firm, there were other areas at Bear Stearns that were experiencing stress. In June of that year, our mortgage department disclosed that 2 internal hedge funds had used significant amount of borrowed money to leverage third-party capital to invest in mortgage-related debt, and that this debt had declined significantly in value. By the end of July, despite a $1.6 billion bailout from the parent company, those 2 funds filed for bankruptcy and were unwound, effectively wiping out all of the $600 million of capital that investors had contributed. The 2 managers of the funds were arrested and faced criminal charges of misleading investors, but they were ultimately acquitted. In December of that year, I along with about 20% of the employees at Bear Stearns were let go. So it was a tough blow, to be sure, but I collected my severance.
December 2007?
That was in 2007, yeah. So I collected my severance, started looking for a job. Luckily, was able to find something not too didn't take too long, but while I was on an interview at a distressed debt fund in Denver, I was asked, "Hey, did you know your old firm, Bear Stearns, is having liquidity problems?" So we turned on the television in the conference room, and I saw the CEO emphatically denying that the firm had any liquidity problems. Of course, anyone on Wall Street knows that when you're denying you have liquidity problems, that's like the kiss of death. And so there was effectively a run on the bank at Bear Stearns, where anyone who had any assets with Bear Stearns were looking to pull them out. At the end of the following week, in March of 2008, the firm was faced with the option of filing for bankruptcy or accepting a U.S. Treasury brokered bailout and a sale to J.P. Morgan. So Bear Stearns agreed to be acquired for $2 a share after having traded as high as $140 a share, less than 2 years before. The deal that had been put together 48 hours before had only gone through after the New York Fed agreed to purchase up to $30 billion of Bear Stearns mortgage assets that J.P. Morgan deemed too risky to assume. I think from the government's perspective, they thought a Bear Stearns bankruptcy would have affected the real economy by causing sort of a chaotic unwinding of investments, forced selling across U.S. markets, something that they actually ended up seeing with the Lehman bankruptcy, months later. So from a personal standpoint, since a portion of my annual compensation each year was paid in the form of restricted stock units that I could only sell after a 3-year vesting period, this translated to a personal loss of about $500,000. On the other hand, I was able to find a job after a few weeks at Bank of Tokyo. Oddly enough, that's where I'm back at Bank of Tokyo. The successor name of the institution is MUFG, but I'm back to the same firm 10 years later, which is kind of interesting. So, of course, the last-minute acquisition of Bear Stearns did little to stem the malaise in the markets, but the panic hadn't really reached a crescendo yet. Then in July, after a series of bank runs that reminded me of, the movie It's a Wonderful Life, the Office of Thrift Supervision closed the California-based IndyMac Bank, which was the second largest financial institution to close in the United States up until that point. And it was forced to mark down a portfolio of mortgages that had been originated with the intent to sell into the secondary market. By the end of 2008, it was clear that a variety of financial institutions were under pressure. Nearly every financial institution became unwilling to lend to other financial institutions on an unsecured basis, since an unsecured loan would likely see a very poor recovery in bankruptcy compared to secured debt. Those who were willing to lend would only do so on a secured basis backed by collateral, and they required more and more margin, thus decreasing the loan to value, effectively reducing liquidity that was available in the market. The upshot was that financial institutions did not have access to the dollars they needed to grow or to even sustain their business. Among the financial institutions that appeared to be most at risk were the investment banks. Lehman Brothers and Merrill Lynch, primarily due to the perception that they were holding assets on their balance sheet that were dramatically overstated compared to their current market values. In addition, after being forced to recognize untold billions of losses on its mortgage portfolios, which had apparently nearly depleted their respective capital bases, the two federal GSEs, Fannie and Freddie Mac, who were the largest purchasers of conforming home loans, i.e. not subprime loans, were placed into conservatorship by the U.S. government with additional backing provided by the U.S. Treasury of up to $100 billion for each GSE. Within a week of Fannie and Freddie being seized, Lehman Brothers was attempting to sell itself to either Barclays or Bank of America in the days leading up to the weekend of September 13th and 14th, and got so far as reaching a preliminary agreement for a transaction with Barclays. However, UK regulators who govern Barclays, the Financial Services Authority, declined to provide their approval of the deal on Sunday, September 13th, which triggered the Lehman bankruptcy the next day. At the same time, in a transaction that probably averted a similar bankruptcy, the investment bank Merrill Lynch agreed to sell itself to B of A for $50 billion. Nearly concurrent with the Lehman crisis, the New York Fed learned that AIG, the world's largest insurer, was teetering on collapse due to margin calls on its portfolio of credit default swaps. Credit default swaps are essentially contracts which permit the purchaser, in exchange for an ongoing fee, to sell a set amount of a reference debt security to a seller at par in the event of a credit event such as a bankruptcy filing. This protects the owner of the CDS against their exposure, investment, and enterprise in the event that enterprise declared bankruptcy. An AIG affiliate had sold billions of CDS on the super senior tranches of mortgage-backed bonds to a variety of third-party financial institutions, including SocGen, Deutsche Bank, UBS, Goldman Sachs, and Merrill Lynch. As the crisis raged, despite the insurance on the super senior tranches, which were the safest, the credit spreads in these tranches widened, which required AIG to post additional collateral with its trading counterparties to cover the swing in valuation of the derivative contracts. In response to these margin calls, S&P reduced AIG's credit rating due to the combination of reduced financial flexibility caused by the additional margin calls. This rating downgrade in and of itself required AIG to post even more collateral, which became a death spiral for the company. Faced with the prospect of letting AIG fall into bankruptcy like Lehman Brothers and seeing the crisis accelerate further, the Federal Reserve stepped in on September 2008, announcing the creation of a $185 billion credit facility, which was ultimately increased to $182 billion to prevent the company's collapse, and enabling AIG to deliver additional collateral to its CDS counterparties. Now, switching back to my own experience, at the same time this was going on, I was working at Bank of Tokyo, who was a lender to both Lehman and AIG and its subsidiaries. As AIG neared insolvency, I was asked to create an analysis over the weekend as to the likely recovery or loss on a significant unsecured loan we had outstanding to an AIG subsidiary called ILFC. This was an investment grade aircraft leasing company. It wasn't pretty. If ILFC had been forced to file for bankruptcy, which almost certainly would have happened if its parent AIG had filed, the forced sale of a portfolio of hundreds of aircraft would have led to a significant loss for Bank of Tokyo. Needless to say, people were pretty relieved when the government stepped in when it did. Less than 10 days later, on September 25th, 2008, following a 9-day bank run, the Office of Thrift Supervision seized Washington Mutual Bank, the 6th largest bank in the United States at the time, and placed it into receivership, with the FDIC being sold to JP Morgan before the FDIC sold it to JP Morgan for $1.9 billion. I think I probably read enough of this, but I'm probably just going to get to the end of this, since you guys have probably learned a lot about this in your class already. You know that the federal government created a Tarp bailout plan, which provided, I think, additional benefits to unemployed folks, but it also created a bailout for banks by injecting capital into banks. It also ultimately provided a transaction account guarantee program, which was extended deposit insurance to depositors in unlimited amounts, which I think was important because at one point there was a run on the money markets, effectively had people who instead of keeping money in their checking account would invest it in the money market, which offered a higher yield. But when everyone was trying to take the cash out of the money market at the same time, that was freezing up the credit markets even more. So they provided that guarantee.
So one thing, just interrupt quickly, but that's what we're seeing now, right? I mean, the Fed really has been very active this time around.
Very active. I mean, it's I would say the amount of money dedicated towards supporting financial institutions, supporting businesses, supporting consumers is probably 5 times what it was in 2008. I think the problem this time around is you have maybe a good 25 to 35% of small businesses effectively shut down. So there's no income to pay their employees. Their employees have all been either, let go or furloughed. They're not able to pay their rent, and so those sort of companies are getting forgivable loans, which is good. Compared to last time around, you don't have the same sort of fears about the financial system, I guess, because people aren't worried that there is, mortgage-backed securities on their balance sheet, which need to be written down, and they're really not worried about financial institutions having enough liquidity. So it is different, I would say.
So one of the people on the call right now is Sean Lynch. Sean, I don't know if you want me to unmute you or you want to jump in just for a second. He also is well, Sean, are you there? I don't know if he's still. He texted me that he was on. I don't see.
I think his phone. He's using his phone.
Okay. This 631 number.
I believe that's Sean's.
So, anyways, he was saying that part of it, the Fed is buying up assets across all asset classes now, and also, I mean, what took a year-ish or months at least is much faster this time around. And I guess the question for him and for you both, do you think this response is because the response this time, is it because of what we learned last time and they decided not to let it go the same, or is it just dumb luck?
Well, I mean, I thought they did a pretty good job last time. I mean, maybe letting Lehman Brothers file was the wrong decision in retrospect, but it seems like they had the playbook from last time around up and running, and I thought it happened pretty quickly that they rolled out all these programs. The idea of like the government buying junk bonds to try to improve market conditions, not really sure how that's going to help, consumers. But, in terms of companies being able to issue debt, which, is a problem if they have like a bond that's maturing, maybe a bond that's yielding, was priced at 7% before, but now market conditions being what they are might require them to pay 20% per year in interest, because the government is stepping in and buying up high yield bonds. That's sort of supporting the market, which is good.
I guess one other, and I don't want to interrupt, but I mean, just what was it? You described it, and you described all that what happened, but like, what was it like for you going through this? Oh, Sean's trying to speak and he won't. Let me unmute. Try now, Sean.
Hey, can you guys hear me?
Yes. Hi, Sean.
Yeah, we can hear you.
Okay, thanks. Yeah, I think the issue that we were seeing is that what's going on is effectively causing a liquidity crisis just across the risk spectrum, and that's big companies, that's small companies. It's not just theaters and airlines. You have many companies that essentially have zero revenue right now and have just a structural cost to their business that is resulting in cash burn. And you might say, well, they haven't planned accordingly. It's really difficult to plan for something like this, right? How do you plan for a scenario where revenue goes to zero? within weeks. Your ability to renege on contracts or claim a force majeure to get out of expenditure. I mean, it's hard to prepare for something like this. And what we were seeing for an extended period of time was essentially no access to the capital markets in a situation where companies needed capital to stay in business. You were seeing all companies, big and small, investment grade and sub-investment grade, fully drawing down on the revolvers. I don't know if I'd call it a run on the bank, but something quite similar to it. You were seeing strain in the commercial paper markets, which were causing even the biggest companies, Google and Facebook and Microsoft, to draw down on their lines of credit. And that was essentially making, in a backdrop where there was no institutional capital, so no investors willing to put money into companies, money leaving the market, everybody selling, so facing withdrawals, and then no banking capital, because all that inaccessibility, the scarcity of capital in the institutional market moved to bank balance sheets. So what the Fed is trying to do is trying to directly address those, so that and a lot of it's changing sentiment, but it's actually supporting all the assets directly. So loans, syndicated loans, are getting supported with potential guarantees under Title IV of the CARES Act. So potentially completely de-risking the credit, so that banks can lend and not incur prohibitive capital charges to distressed credits. Might actually help syndicate loans if we're able to actually distribute those loans that have a government guarantee. We're still figuring that out. They're supporting CLOs, which collateralized loan obligations, which, Kevin, as you know, are some of the biggest buyers of loans in our market, and supporting their higher rated tranches of that waterfall that will, on a relative value basis, tighten up those vehicles that are levered and essentially have been on the sidelines for over a month. And without them playing in the market, you have certain hedge funds and distressed special opportunity funds are the sort of lender of last resort. And like you said, they're looking for 20% type returns. And for a company that has no cash, that's challenging, even from a feasibility perspective. And they are now directly buying in the high yield market. They are buying through BlackRock, who they've anointed. They were anointed as their proxy when they started buying in the investment grade market. Now that's expanded to other classes of debt. Now, I don't expect them to be the primary lender in all these emergencies, but it's definitely changing sentiment that there is some sort of safety net. And it's changing the risk appetite of investors. It's changing the risk appetite of money managers and retail investors. And so what we've seen is, instead of money leaving the market, we're now seeing money come back into the market. Now, we can argue if it's premature, but what I'm seeing is just in a matter of weeks, in my view, Kevin, was that it really took, between the stimulus measures and the FDIC measures and all the things that were done in the last crisis, it felt like it took months for that to materialize. And it felt like we've come up with a similar, if not more expansive package this time around in a couple of weeks. It'd be interesting to get your views on that.
No, I totally agree with that. And just to add to your point about the CLOs, I mean, one thing that we saw during the last crisis that is really not an issue during this crisis is a lot of the CLOs were driven by market value, meaning that if market value passed below certain thresholds, the documents within the CLO required a sort of an unwind where basically all the assets would be sold, and that just put more selling pressure into the market. This time around, I don't even know if they do market value CLOs anymore, but they're more static pool CLOs that didn't have those market value tests. So you're not seeing the sort of forced selling that you saw last time. Not that there isn't a lot of selling pressure anyway, but all of the measures that were discussed about the federal government coming in to buy assets across all asset classes, except for stocks, I think at this point, has really done a lot to improve liquidity in the market. I think people realize that this is it's temporary in that this pandemic will go away at some point, and this is not necessarily, as long as we continue to support the markets, I don't think we're going to see a Great Depression. The problem is, you have economists who are talking about unemployment rates spiking to as high as 20%. as long as the markets are there to provide capital to businesses to sort of restart, that will happen. So.
How about students? Any questions for, even if, I mean, and put them on the spot. What was it like living through this? I mean, you talked about what happened. I don't think you never really described the angst, the panic in the pit of your stomach when all of this was happening, and jobs were being lost, and you got let go from Bear, et cetera, et cetera. I think they would be interested in that.
I was very close to what was going on, and was reading about it every day, and really thought we'd see a run on the financial system where you could have multiple financial institutions close, and maybe you wouldn't have your deposit insurance covered by the FDIC. So the idea of seeing a bank run out of It's a Wonderful Life wasn't so far-fetched, and I sort of was half expecting, and I'd look out my window in my office every once in a while, the bank across the street, sort of half expecting to see a line appear as people were trying to withdraw money. And there was a bank run going on. It was really just more of an electronic bank run where hedge funds were withdrawing money from banks. I'm not sure where they were putting it if they weren't at banks, but everyone was sort of seeking liquidity and just selling assets left and right. So yeah, I mean, it was definitely very stressful, because you wonder if the money you have in the bank is going to be there tomorrow, and whether it's safe, and whether you're going to be able to pay your bills. So, and that we're seeing this time around as well.
You talked about how in 2006 you heard the barber talking about how he was trying to flip all these homes. Was that something that sparked your interest at the moment and made you worried about the mortgage business, or was that something that you looked at in retrospectively at the end and realized that was a clue afterward?
No, funny you should mention that, because literally I came back from that vacation, and I sat down with my colleague who I shared an office with, and we literally were thinking about ways we could hedge our stock, because the financial markets at that point in time were just in great shape and everything was rosy. But I heard that story and I was like, this is not good. This is like a canary in the coal mine moment. So there was, at that point in time, you couldn't hedge stock of your own firm. That was against the rules. But what you could do is buy puts on the XLF index, which is an ETF for the financial services market. And my colleague and I had actually looked into hedging our restricted stock using puts on the XLF. And I think we determined it would cost about 30% of whatever we were holding. And we said, oh, well, that's too much. We can't do that. I mean, that would have been a great trade in retrospect. But yeah, I would say definitely that was definitely a warning sign that I should have heeded a little bit more carefully.
Hey, Kevin and Sean. First of all, great conversation. Appreciate you both coming on. I have a question regarding the credit ratings of Delta and Boeing. We've seen them both decline in credit ratings, which is similar to what happened to AIG in 2008. Do you think there's a potential of companies like this going either bankrupt or getting bought out by perhaps competitors?
Well, I think the government will step in with some sort of assistance, whether it's a loan, whether I mean, it seems like to me, and I think Boeing has actually already projected this, that the government would make some sort of a loan and then take a portion of their equity, like they did on the AIG assistance, trade. I'm not really familiar with Delta's situation, but I think the U.S. government feels like Boeing and the airlines are critical infrastructure that they're going to support. Whether that means the shareholders will see some sort of assistance, I sort of doubt it. I think they should take a bath, but as a company, they should they should both keep continuing operating, in my opinion.
Thank you.
Yeah, I don't think it's hard for me to imagine that ever happening. Like right now, like with the CARES Act, one of these multi-trillion-dollar pieces of legislation that's gone through. There's actually an enormous sort of silent piece just for airlines, and then above and beyond that, there are other elements of that act that allow for loans pursuant to certain executive compensation and buyback limitations, like stock buyback limitations. So there's actually something that just hit the ticker about 10 minutes ago that Boeing has hired Lazard and Evercore to explore potential government solutions. But like if the decision is between going bankrupt and taking a very ugly piece of financing for the government that allows you to stay in business, no board is going to recommend a forfeiture of all equity value and essentially a seizure of the company by the creditors in exchange for just a type of financing that is expensive or dilutive. So it's hard to imagine that this time around, big, large employers like that are going to go out of business. That's my perspective.
Yeah, and to be clear, the last time around in the AIG rescue financing, they did get this massive loan from the government, but it wasn't like it was on favorable terms to existing shareholders. I think they got 79.9% of the equity stake in the company and had a pretty onerous interest rate, but there were really no other rescue financings available at that point, and faced with the option of going bankrupt or accepting the government bailout, and it was pretty easy choice to make. Even Citigroup, who I forget the sort of assistance they got. It wasn't the typical Tarp money that other banks got. I think it was some sort of hybrid. Their existing shareholders were substantially diluted. So if you were a shareholder back in 2006 or 2005, your market loss was something like 80%, 90%, even years later, because they were so diluted.
Thank you.
Sure.
Other questions?
I have other ones if no one else has any.
Sure, go ahead. Why not? Live it up, Matt.
Thank you, Dr. Mahar. So when do you guys foresee us going back to normal life, and how long do you think until we bottom out, or do you think we already did see the bottom?
Well, I mean, if you believe that the stock market is a leading indicator for the economy, I think it bottomed out March 26th or something like that. I haven't really followed what's gone on today, or maybe the market is even closed today, but I think it'll be 6 to 9 months at least. I think, well, first of all, I think unemployment is just going to keep going higher. I think you could probably reach 20-25% before this is all over, but it'll really depend upon how long we're sort of shut down, because if we're shut down for 3-4 more months, it could get a lot worse. But another month I could see, it seems like a realistic scenario for the economy to start opening up again. The problem is you have a lot of small businesses that had no income for a period of time, still had cash burn because they're paying some employees and paying rent and things like that. And the question is, do they have enough money to restart operations? So that'll be a big challenge. I'm not sure if the government is really, if their assistance program has contemplated that, but I'm sure that will be addressed at some point. So I guess bottom line, I think that this will be, slowly get back to business. And actually my ending comments for the speech I gave, or the talk I gave back in 2016, was probably a good way to end this for me, is that be optimistic about the future, because things always get better when things seem the darkest. And I think things seem the darkest probably back on March 26th, and it's already getting better. And that also means that companies need to be prepared for unforeseen circumstances, like not depending on short-term funding and having enough liquidity on hand to manage through difficult circumstances, such as market dislocations and recessions. And then for individuals, just means having enough cash on hand to manage through potential periods of unemployment like we're seeing now.
Thank you.
Sure.
How about one final one before we do have to wrap up? But what advice would you have? And that's great advice for at the corporate level. But either of you, or in particular, Kevin, what advice would you have for students right now, whether they're looking for an internship or whether they're graduating and going to be hitting the job market? I mean, unemployment's high. I don't think many people are out actively hiring right now. What would you suggest?
Well, let me just bring up an example of, there was a guy who graduated, I don't know, it's probably 7-8 years ago. Kimball, do you remember his first name?
Greg?
Jim?
Greg, was it? I know Greg Kimball. I'm not sure that's who we're talking about.
Yeah, I'll have to look it up maybe more while we're talking. But so back in 2012, he had just finished his MBA at St. Bonaventure, and he sort of came to New York not having a job. He basically slept on people's couches, worked at, I don't know, TGI Fridays or something like that until he found like his first professional job. But he just really worked it in terms of like meeting up with alumni. I mean, he of all the people I know in New York who are my peers, he was probably in touch with half or more of them. I mean, he really went out there and tried to meet people, and it was really just not, hey, can you get me a job? It's really just, he'd have like an in-person meeting with each person and just tell people, about his background and what he liked to do, what he thought he was good at, and just sort of put it out there and hoped something would come back, and something did come back. He ended up getting a job with another guy who graduated, Matt Davis. Do you remember Matt?
Yeah.
He got a job with Matt Davis's firm, which is a hedge fund. I think they're based in Boston now. As sort of a entry-level analyst type person, and now he's like the controller for the whole firm. So, it's really using your alumni contacts, and really knowing the right way to do it. It's not like, hey, can you get me a job? It's just more like, hey, I just want to make you aware that I'm looking, and here's what I like to do. And so if any opportunity comes your way, you might think of me. I thought that was it was very impressive and very professional of him. So.
Yeah, I would say, guys, that it's tough, right? Like, you have to approach it like a full-time job. Like, you have to approach getting a job like a full-time job. You can't expect, like, you have to understand the context in which, like, the whole, staffing dynamic occurs. It's like, there's an HR person that has meetings scheduled all day, and then during that time, they get 1,000 emails a day with candidates, have a limited amount of time to go through them. Like, and then that just piles up day after day after day. Like, their ability to actually dedicate time, read through every resume, pick the best candidate on merit, it's limited. And that's why you see investment banks very lazily just recruiting from the top 10 schools in the country, and they use their admission status as essentially a proxy or a pre-screening mechanism to make their job easier, when it's not always the case, right? To be honest with you, like, some of the strongest people on my team are those that are have something to prove, are from a normal family, a normal school, are smart and hardworking, have a good work ethic, and really want the job. It's not the Dartmouth art history major that got the interview because the bank was recruiting on their campus and tick a certain bucket from a diversity perspective, in terms of academic diversity and background. you know, it's nice to have a job that pays a lot of money. Yeah, it's kind of a call option on them to see if they want to pursue finance. You know, like you have to work it. You gotta figure out what type of questions they're going to ask. You need to figure out, you know, many times people ask you, like, what do you want to do? You have no idea. Use the internet to, like, teach yourself, and use forums and not chat rooms, but forums and Reddit sub articles to just figure out, like, what people do in that job, what candidates have done. Look at, like, Wall Street Oasis or other sort of, like, college resources for the finance industry. Try to get a feel for what they do. Keep up on your alumni. Like, we don't want to ignore you at all. It's just that, like, from morning till night, 7 days a week, we're working. It's oftentimes like this. Things are just, you know, you're dealing with emergencies, companies that are trying to avoid bankruptcy, employing thousands of people, high stress environments, challenging banking environments. There's just limited time in the day, so don't feel bad about emailing us every day, calling every day. If we don't answer email, call, text, like, just multiple channels. Stay on top of us. You know, make your own network connections. Don't expect, like, career services or just a bank or an institution to just, you know, plop an opportunity on your lap. Like, you're going to have to make your own wind in a market where there is no wind. Okay. And so I would say, like, treat it like a full-time job. Dedicate hours to it every day. You know, set reminders to follow up with people that you want to talk to. If they don't have an opportunity, ask if they know anybody else that, you know, would have experience in the particular sector that you're looking in. Ask, like, use those calls as, like, opportunities to ask stupid questions, right? It's almost like, you know, fake it till you make it, but, like, use those conversations not to, like, say, oh, I really want a job, but, like, tell me about what you do. Ask questions. And it's amazing. By the time you ultimately get the interview, you know, having spoken to 5 or 10 people that maybe work in that industry, all of a sudden now it's almost like you've had 10 practice interviews for that interview. So you come in, you know the type of questions to ask, you know what the answers can be, you know what the follow-up questions to ask are. It shows perspective, and it shows that you're really prepared. And frankly, that's what makes a difference in moving forward in an interview process. So that would be my long-winded recommendation to you guys. People are going to hire again. This is an exogenous effect, and it'll take some time to work out of it. You know, I think corporates are behaving different than the last recession. They're looking to provide some level of safety net. You know, the government is encouraging them to do that, and there are government support measures that also encourage that type of behavior as well. And so I would recommend you guys really go at it and grind, and not wait for it to land on your lap, because in this type of backdrop, it won't.
And just to add to that, one thing I would say is, you know, for every contact you make out there, at the end of the conversation, ask for introductions to maybe 1 to 3 other people that might be willing to have a conversation with them, because you keep doing that, and all of a sudden you're going to have, 50 people that have heard your story, and, you know, you'll start getting calls. Believe me, that's how it works. And yeah, and also, if to the extent there is sort of a time period where it may not be possible to find a job, maybe between now and the end of the summer, that shouldn't stop you from looking, but use that time to, sharpen your skill set, maybe take a course to, learn how to program in Python, or, something that would sort of differentiate you between you and the next person. Companies like to hear stories about people who use downtime to improve their skill sets. So that's, it's a good indicator for what sort of employee they're going to be.
All right, well, thank you guys.